Vunani has reported an 83% reduction in net finance costs and earnings per share of 9.3 cents. Joining us now to unpack the results further is Butana Khoza, MD of Vunani, and Ian Cruikshanks. He's an independent financial analyst. Well, good morning, Butana. At the top of your results statement, you talk, perhaps one of the main numbers is earnings per share at 9.3 cents. The first statement in your statement is that you have an 83% reduction in net finance costs. That's obviously important to you.
No, indeed. I think finance costs has been one area that held us back historically. I think no matter how well we did in our operations, the fact that we were running up this huge bill to financiers meant that we couldn't really kind of get ahead. And what happens is when you don't service your debt, it effectively rolls up. So to effectively redeem our debt means that in future the results of our operations and the cash that we generate is really available to us to grow our business going forward.
How did you do that? I mean, you must have done some things differently, or certainly had a special focus on it.
Yeah, no, definitely it was a special focus. I mean, in the end we had to effectively come up with some kind of settlement terms with our funders. That enabled us to basically put that whole scenario behind us and to really start looking at generating cash and retaining cash to fund those particular businesses going forward. I think it was successfully concluded at the end of last year. We still had remnants of it at the beginning of this year. But I think for all intents and purposes, I think the theme that we'd like to become more prevalent is the fact that legacies are the things of the past. We've effectively dealt with them. We're really focusing on the future. We think we've got a good, stable platform which should generate profits going forward. You know, this is our third consecutive reporting period of profits, and I think that we're well on our way.
Tony, can I just ask a question? You mentioned financing and coming to terms with your funders. Yeah. Was this in fact financing working capital? No,
this was actually investment related. It was investment related debt, which effectively we've redeemed through sales of certain investments, which proceeds were actually used to pay back that debt.
I see.
Let's look at the statement where you say we had the effect of unpredictable market conditions. Revenue was static at 5 million, and it'll be interesting to talk. Revenue has been an important number in the banking sector recently, with ABSA's revenue being so low at 13, and I see that Nedbank's revenue is much higher than ABSA's, looking at their results this morning. Right. We'll get to Nedbank in a while, but your revenue is static at 5 million. The effect of unpredictable market conditions in each of the areas that you work in?
Yeah, look, I think it is a fact that statements around quantitative easing and the ending of that particular period would have created some level of volatility in the markets. Now, we do have businesses that are exposed to the capital markets. You know, we run a stockbroking operation. We have an emerging fund management business, and therefore, that volatility does actually affect trading. We would have seen it in our stockbroking business. Also in our fund management business, having had, I think, a 3% movement up in April in the markets, or down in April, and 7% up in May, and then 5% down, that does kind of wreak a bit of havoc with valuations. And obviously our revenues are based on the valuations of the portfolios that we manage. So that volatility does have an impact. Naturally, the uncertainty in markets does play on some of our underlying investments, which are in industrial companies. It makes planning very difficult because you don't really know how things are going to actually pan out. So those kind of things would have also had an impact on that particular area. I think the stability we have we've seen it also in our advisory business. The uncertainty does make certain transactions, it creates long lead times on concluding deals. It does actually also have an impact on valuations on transactions. So we've seen it in that particular business as well.
So looking at the fund management business, with the possibility of having had a huge run in markets worldwide, but particularly more noticeably so in developed markets than in emerging markets, you have an emphasis on the emerging market sector. Do you think we may be looking at that sector being in a consolidative stage for a bit longer than we've looked at in the past? And if that is so, is that going to apply to your earnings stream as well?
Well, our earnings stream is really, I think we've come off a very low base. And if you look at, for example, what our funds under management in our fund management business were at December last year, about 11 billion. We've ended up at about 13.5 or thereabouts in June. So we are actually in a growth phase. There may be certain consolidations in certain markets depending on how much momentum is in those particular business. I think we're in an upward momentum cycle. So, we're pretty bullish around our fund management business. Consolidation is always a factor. I think it's going to be more of a factor in some of the smaller cap property fund mancos and some of the smaller property funds, definitely.
I was going to say, Butana, what about the property sector? Because a lot of those shares are listed on the exchange. But it's a different kind of sector to all the other equities. And how has that, in particular, reacted to the uncertainties that you've been talking about?
Yeah, we've also seen upward and downward movements. I think, as with most capital markets in South Africa, obviously global capital flows are a big factor driving liquidity in our market. I'm not sure it's as much of a factor on the property side as it would be in bonds and equities. And so perhaps there we've seen a lot more domestic participation in that particular sector, and so the impact has probably been less felt. There has been a correction, I think, in the last month, but it seems to have clawed back. I think for where our funds basically operate, the sense is that there's still growth opportunities, and so I think we're seeing performance sort of moving in the right direction for us.